income tax, capital gains tax when it comes to trust. That's what we'll be looking at in this video. Before we go on, don't forget to like, comment, share and subscribe to our channel. My name is Omar Aswat and I am a Chartered Tax Advisor regulated by the Chartered Institute of Taxation. Now, nice short video probably, or hopefully. We'll be looking at income tax initially. So, income tax on a discretionary trust and income tax on interest in possession trust, the rules are slightly different. So, for discretionary trusts, the first £1,000 of income received by the discretionary trust is normally taxed at the basic rate 20% and 7.5% for dividends. Sorry, 8.75% now. So the first £1,000 of income is taxed at basic rate. Any amounts in excess will be taxed at the highest rate of tax, which would be 45%. So the additional rate of tax at 45%. When the income is actually paid out to the beneficiary, there will be a 45% tax credit attached to that payment. Okay, so the trust, discretionary trust, is releasing income to the beneficiary, the individual. It will come with a 45% tax credit attached. Now, if the beneficiary, let's say, is a basic rate taxpayer, 20%, then the excess can be claimed as a refund on the self-assessment tax return. Does that make sense? Because the trust has effectively paid 45% tax, okay? But the beneficiary was only a 20% taxpayer or 40% taxpayer, so the excess that the trust has paid is reclaimed by the beneficiary on their self-assessment tax return. I hope that makes sense. Then we move on to income tax on interest in possession trust, and this is normal, as in there's no 1,000 and then additional rate. It's all at basic rate, so it'll always be at basic rate at 8.75% on dividend income and 20% on all other income. So then it's the flip, because if the beneficiary then is a higher rate taxpayer or additional rate taxpayer, what do they have to do? They then have to pay the additional tax through their self-assessment tax return. Makes sense, of course. And sometimes the trustees mandate the income directly to the beneficiary. So it goes directly to them instead of being reported or passed through the trustees. And in that instance, then that income it's literally a source of income straight onto the beneficiary's self-assessment tax return, completely as normal and taxable at the beneficiary's marginal tax rate. Now, when it comes to capital gains tax, the trust is a separate legal entity. That's the first thing. And just to mention that the trust also has an annual exempt amount, which is 50% or half of the annual exemption amount for individuals. So it's about 6,150 if I've kept up with the tax years. But when it comes to capital gains tax, broadly speaking, on the introduction of the set law introducing assets or settling assets into the trust, there may be there'll be potential capital gains tax at that point. So yeah, so it depends on what asset we're looking at. If it's cash being introduced, then obviously there's no capital gains tax on cash. But let's just say a property is being transferred into trust. Just to mention that the cash will potentially have the lifetime inheritance tax due, which is mentioned in the inheritance tax video. But let's just say we have a property. Now, that property will be a disposal by the individual to the trust. So there's potential capital gains tax. Now, if there's inheritance tax also due, then there is potential to defer the gain under 260, Section 260 TCJA 1992. Or potential gift relief can be claimed under Section 165 TCJA 1992 as well. So capital gains tax will be due on the individual making the disposal, but can potentially be deferred. Asset sits in the trust. On its way out, as will be mentioned in the inheritance tax video, there will be an exit charge, or as already mentioned, that video has already been recorded. But there will be an exit charge on the trust, which is at up to 6%. Complex calculation that needs to be looked at separately. Now again, there's potential CGT relief available under Section 260. Section 260 quite specifically says that there'll be no, or there's potential to defer a gain for capital gains tax purposes if there has been an inheritance tax charge, which in this case would be the exit charge that's arising. So that's mainly the capital gains tax position. There's also obviously rules relating to PPR, for example, and obviously each scenario needs to be looked at individually. This was just a complete outline video, which I really hope was beneficial for you. I hope was useful to you. And if it was, then don't forget to like, don't forget to comment, share, and subscribe to our channel. Thank you as always for listening. Thank you for watching. Leave your comments down below. Feel free to contact me. My name is Omar, Chartered Tax Advisor. Have a good day.